I'm Tim Sustak, Chief Treasury Officer with Vizo Financial, and this is your FOMC update for the June 2023 meeting. At its latest meeting, the FOMC chose to leave the target Fed funds range unchanged at a level of 5 to 5.25%, and they also kept the rate on reserve balances at a level of 5.15%. The decision was a unanimous one and was generally expected by the marketplace. What was maybe not as expected was a change in outlook moving forward, but we'll get to that in a minute. There was not much change in the post-meeting statement, other than to say that holding rates steady gives the committee time to assess additional data to see if further policy firming may be necessary. We also received an updated summary of economic projections from the Fed this month, also known as the SEP. The Fed funds dot plot may have surprised some to the upside. Based on median projections, the committee now sees a Fed funds target of 5.6% by the end of 2023, which is 50 basis points higher than the March projection and signals 2 more 25 basis point increases this year. In 2024, they see the rate moving down to 4.6% by the end of the year, which is 30 basis points higher than the March projection. We'll see if Chair Powell gave us any further information about the change in the rate outlook in his press conference after the break.
Your employees are more than just people who work at your credit union. They are advice givers, solution seekers, and unwavering advocates for your members. It's only fitting that we be their advocate too. With iCare through Vizo Financial and our partner, Interlutions, your credit union can offer better employee health care for less. Gain access to more providers, build custom plans, and minimize your costs through cooperative buying. These people are the face of your credit union. Make sure they're always smiling with iCare.
Welcome back. In his press conference following the meeting, Chair Powell first gave his prepared remarks. He explained that the economy continued to expand at a modest pace with a pickup in consumer spending, though housing remains weak given higher rates, and business fixed investment is being weighed upon by higher rates and slower output growth. The labor market remains very tight with robust job creation and low unemployment, though the committee expects labor supply and demand to come into better balance over time. The committee generally expects subdued economic growth to continue. Inflation continues to run well above the committee's 2% longer run goal, and the committee expects it will be appropriate to raise rates further by the end of the year. However, in light of how far the FOMC has come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, they decided to maintain the target range for the federal funds rate at its current level and to continue the process of significantly reducing securities holdings. In the question and answer session, it was asked what changed since March to cause the rate outlook to move up. Chair Powell said that the committee is following the data in the outlook and that the labor market has shown surprising resilience. He reiterated that decisions moving forward will be data-driven and that the projection is just an outlook at a given point in time. In response to questions about why the committee is waiting to raise rates if they see that as necessary, he indicated that as the end of the rate hike cycle draws near, it makes sense to go at a slower pace to determine when you have done enough, but not too much, and that given committee projections, they are near the end. He mentioned that the decision to leave rates unchanged was just a decision about the June meeting, and the committee did not discuss how to move forward. However, he also said that July was a live meeting concerning a possible increase. He said further that risks concerning inflation are still to the upside, that it's too early to assess the full extent of credit tightening, and that the committee is unified in their desire to get inflation back down to 2% over time. So, with the rate hawks flying around, those in the marketplace that thought rate cuts were coming this year can finally let that go. The Fed continues to make it clear that fighting inflation is job number one, and that means that rates will likely be higher by the end of this year, not lower. That's the FOMC update for June. Thanks for watching, and be well.